Hi, my name is Jordan Wilson. Today we're going to take another look at identifying relevant benchmarks to create when you want to assess and review your portfolio. Now, in the previous episode, we looked at some very common, simple benchmarks. Zero return. Anything that's positive is good. Anything that beats inflation may be good. The real rate of return. Maybe you want to compare your portfolio to a risk-free asset. Or you might just have a arbitrary number that you choose. You want to earn 10% per annum. You need to earn 6% compounded annually in order to reach $2 million at age 65. But those are kind of apples and oranges with most portfolios unless you're very low risk. So we want to start finding benchmarks to use that are a little bit more relevant to the typical investor's portfolio. Now, in every episode building up to now, I've espoused passive investing for the most part. And under passive investing, you invest in index benchmark funds. So when you're creating benchmarks to assess your portfolio, if you're a passive investor investing in index funds, it should be quite simple. And that's where we're going to start off today. Now, I think the thing with index investments is there are so many out there, and there are so many benchmarks that track different indices. In 2018, there were 3.7 million indices on offer covering every type of asset class and subclass. In 2019, it had shrunk to 3.0 million, and that's based on sort of periodic decommissionings, consolidations, just sort of pruning the leaves a bit. But even falling to 3.0 million, that is a heck of a lot of indices that you have at hand to match to your portfolio. In fact, it's probably too many because it can tend to be a little confusing. The paralysis by analysis thought process. But there is a lot out there. They're easily available, and they cover all the asset classes and subclasses that you will have in your portfolio. You want to find one or multiple ones that match your specific index. If you're invested in the US large cap equity market, probably the S&P 500 benchmark would be appropriate. If you're invested in Canadian equities, maybe the TSX capped composite or the TSX 60, depending on the type of investments you choose. But if you're invested in, say, Japanese equities, you probably don't want to use the TSX or the S&P 500 as the appropriate benchmark. In this case, you'd use probably the Nikkei 225 for your benchmark, which is Japanese. If you have a global mega cap portfolio, again, maybe the S&P isn't correct because that's US centric. In that case, perhaps the Dow Jones Titans might be more relevant. So again, you need to sort of find your portfolio and then identify benchmark indices that match. The other thing that can help out, especially if you're in mutual funds that are maybe actively managed, say if you go that route, is usually the prospectus or the fund fact sheets will disclose what benchmarks are being used. Or if you use a company like Morningstar and you look at their analysis of a mutual fund or ETF, they'll usually in the top right hand corner disclose what index they're using to make their comparisons. So if you're not 100% sure of what index to use, you can usually find it through a ratings company or through the fund company's fact sheets or prospectuses. Now, I think for most people, you're going to need multiple indices because we tend not to just invest in one thing. I may have a portfolio that's 65% equities, 35% fixed income, and 10% real estate. The S&P 500 or the TSX capped composite may or may not be appropriate on the equity side, but it's definitely not appropriate on the fixed income or the real estate side. So again, you need to find different indices based on your different asset allocations. And even within, say, the equities, if we have 65% of our portfolio allocated to equities, we may have 5% allocated to Canada, maybe 40% allocated to the United States, and 55% allocated to the rest of the world. And maybe some of that rest of the world is in emerging markets or even frontier markets, which are smaller still. Or they might be in value stocks or growth stocks. So you want to try again to find an index that as closely matches your portfolio as is possible. And as we just discussed, you want to allocate based on your target asset allocation itself. And I think the key point here is that you're doing the benchmarking in conjunction with your target asset allocation. That's before you start investing. Don't invest and then a year later say, okay, I'm going to do a portfolio review. What benchmark should I use? No, you want to set that up ahead of time because part of it is to keep yourself honest. So it's, okay, here's what I set up. Here's my benchmarks. Here's my asset allocation. They match. And then a year later or whenever you do your portfolio review, you can compare again back to day one upon creation. And the second part is that part of your portfolio review is going to be deviations from the target asset allocation. If I've got a simple 70% equity, 30% fixed income asset allocation targeted based on my investor profile, a year later, there's probably an 80 or 90% probability that I will not have that 70-30 split because maybe equities outperform fixed income or the opposite. So I may end up with 80%, 20%, or 55%, 45% bonds. So we need to go back to the start, to when we set up. And part of the analysis process is how much of that return differential was due to getting out of alignment with our target asset allocation. And do we need to bring our actual portfolio back in line with the targets? So I think that's important as well. So when you're setting up the benchmarks for the portfolio reviews, do it when you set up your target asset allocation initially and not wait until you do your first review. And then down the road, as part of the review process, you're looking at your own investor profile to see if there's any changes and whether that should be changed in your target asset allocation. And if you make changes to your target asset allocation down the road, then you also may want to adjust your index benchmarks. So that's kind of an overview of index benchmarking. Now, the one thing I'll say with the index funds and the index benchmarks is that your actual performance should, and probably will 95-99% of the time, underperform the benchmark. And there's two reasons for that. One is tracking error. So if I'm invested in a S&P 500 index fund and my benchmark is the S&P 500, you'd expect the performance to be exact, but it'll be a slightly lower. And one of the reasons is the tracking error. And tracking error is how closely a fund tracks its benchmark. And part of that is the construction process of the fund itself. It could be full replication of the index. So if I have 500 stocks in the S&P 500 or 30 stocks in the Dow 30, I buy all 30 or all 500 in their proportionate weightings, and I fully replicate that benchmark. But as you can imagine, that can take time. It can take transaction costs. So often fund companies will do sampling. They'll sample the 500 companies in the S&P and create a partial replication that closely mirrors the overall performance, but maybe they can get by with only holding 50 or 80 of the 500 stocks. So it's more cost effective, but because you're not owning everything, maybe you run slightly higher risk of tracking error. And then you have companies that do what they call synthetic replications, where you're using derivatives or futures, forwards, those sort of things, to synthetically replicate the overall market. And there's pluses and minuses with that. Usually they can be cheaper than full replication, but maybe you get the timing wrong and you have some tracking error. The other side of the tracking error as well is the timing and the cost of the trades. In this case, when I talk about costs, I'll talk about opportunity costs. So indices are living, they're organic. New companies come on, old companies fade away. And every time that an index changes its components, the index funds have to replace the old with the new. And so there's a timing of the trades. If you're slow or if you're fast, that may put you out of sync with the index as a whole. And the pricing opportunity cost is maybe the price has gone up because everyone else is jumping in. Maybe it's fallen. So again, you can have small variations in price based on your timing of the trades, and that can affect your annual performance. So those two things tend to result in underperformance of the actual index fund versus the benchmark, which does things instantaneously. Another part of the underperformance are the actual fund expenses. The benchmark index has zero costs. It's fully replicated. There's no transaction fees. There's no costs involved. But the index fund, it should not have any management fees because it's passively managed, but it's still going to have some costs. You're going to see costs for operations, how to just manage the fund. You're going to have things like shareholder communication, regulatory filings, commissions when you do make your trades. So every dollar that's spent on fund expenses reduces your net income to some extent. And that's why even in index funds, you still need to compare different investment opportunities and find those that are more efficient in managing their funds so that they have minimal tracking error and minimal operating costs versus their peers. So that's a little bit on the index funds and the index benchmarks that are usually very easy to apply if you're passively investing. If you actively invest, you can still break things out. So if you're invested in Google, Amazon, Tesla, Facebook, Netflix, those are going to be, US large to mega cap stocks. So it's easy to find a benchmark that is useful to associate. If you're investing in 3 or 4 junior oiling or mining companies in Western Canada, it may take a little bit more work, but there's 3 or 4 indices that you can use that match those. It's not going to be a full one-on-one perfectly correlated, but you can find stuff that works. That's all I want to talk today about the relevant index benchmarks. And then we'll move now in the next episode into things like comparing against peers and target asset allocations and those things. So thank you for your time today. Have yourself a great day.